Welcome to Yahoo Finance's special coverage of the May CPI report. I'm Madison Mills alongside Brad Smith. The key inflation print crossing the wire right now. Let's get you those numbers. CPI month over month coming in a touch soft. The survey indicating 0.2% growth. It actually came in at 0.1%. Year over year, Bain in line with estimates, coming in at 2.4%. CPI ex food and energy year over year also coming in just a tick below the survey number, coming in at 2.8%. That is below the indicated survey number of 2.9%. Also want to get you the CPI core index coming in just a bit soft as well. And again, we have CPI ex food and energy month over month. That's actually the softest number, coming in at 0.1%. That is below the survey data of 0.3% and also below the prior month's reading, which came in at 0.2%. Taking a look at futures moving to the upside firmly off the back of this print, perhaps indicating a slower inflation picture than we had thought given tariff policy.
Yeah, fractional gains for the U.S. major averages. A few of the indexes that I like to keep track and tabs on here. The food index specifically, near and dear to a lot of people's stomachs out there. Food index increased 0.3% as both of its major components, the index for food at home and the index for food away from home. So those of you still getting those margarita deals at TGI Fridays, you're still going out there in full force here. That rose by about 0.3% though in May. In contrast, you actually saw the energy index decline 1%. We've heard a lot of economists kind of lean into where we've seen some retreat in the price of gasoline. That gasoline index fell over the month as well here. So that was noteworthy here. You also did see a few of the areas here, the indexes for airline fares, used cars, trucks, new vehicles, and apparel among the indexes that decreased in May as well. So a lot to keep tabs on there, especially within the retail landscape. Yeah,
and something I think that will be interesting to talk to our guests about is that there was this concern about goods leading to a big uptick given tariff policy, but we actually saw the index for shelter rising 0.3%. That was the primary factor in the all items monthly increase. So we have a soft inflation print driven by shelter as opposed to goods inflation as well.
Spot on. Joining us now to break down this inflation print, we've got Joe Brusuelas, RSM chief economist, and Claudia Sahm, who is the New Century Advisors chief economist and former Federal Reserve Board economist. Great to have both of you here with us. Joe, I want to begin with you and just get your initial takeaways. We were reading through some of your blog posts this morning, so I wonder how much of it kind of mirrors to your expectations coming into the print.
The big surprise was the large decline in energy at 1% and a really large decline of 2.6% in overall prices in gasoline. We're not really seeing much of the pass-through, if some at all, from the tariffs. Most importantly, we saw a decline of 0.3% new vehicles and 0.5% used cars and trucks. So that really did provide the much softer print than I expected or many analysts. So that's really, I think, the primary takeaway right now. But don't get too comfortable. When you hike prices by 10 to 15%, it gets passed through eventually.
Well, Claudia, let's bring you into the conversation. Do you think this softness that may have been indicated by the headline numbers is to be believed?
I think it can very well be an accurate picture of where we are as of last month. It's not necessarily really telling us where we're headed by the end of this year. And that's a big question as to exactly how these tariff costs, which we know they're being collected, we see them in the Treasury statements, where are they going to go? Showing up in CPI is not the only place that they can go, but it's really too soon to be saying we're, clear path back to, 2% inflation.
So, Claudia, with that in mind, it seems like the prevailing thought in the markets, at least, is that the worst of the unknown in terms of some of the tariff negotiations and policy talks, that seems to be behind us. So what would that signal for the back half of this year, especially as we're waiting for some of those deals to net out, and how long the tariff overhang could start to bleed through in a more powerful sense into some of these numbers?
Right. Well, again, even with where the tariffs are right now, at the level they're at, which is much lower than some levels we had seen earlier this year, they're still 6 times what they were before we came into this year. We still have an adjustment. In the real world, adjustments take time, and businesses have took efforts, built up some inventories, tried to, slow things down. So again, I don't think we have a picture yet of what the costs really are from the current policy yet, even if that policy doesn't get any worse.
And Joe, it makes me wonder whether we, as investors, is Wall Street sort of past the point of being too concerned about tariff policy? We're also having some tariff headlines crossing this morning. The president saying the deal with China is done, but we saw futures hitting session highs off the back of the inflation data. Is the market back to focusing on the inflation data primarily?
No, this is likely to add to the complacency in a market that's priced for perfection right now. My sense is when I look at this, I see some good things. Ex-food, energy, shelter, inflation was flat and is up 1.9%. This is a function of the really heavy lifting done by the Fed over the past several years. However, again, when your effective tariff rate is over 15%, you're going to see some pass-throughs. It's just a matter of time. When I look at the inflation report this morning, I see on a year-ago basis, services are up 3.7%, housing's up 4%, and shelter's up 3.9%. We're back within ranges that I think are tolerable, but I'm not expecting much improvement in those indices. Again, what I'm really worried about is going forward is the impact on goods prices. More importantly, the impact on food prices. Notice that food prices were up, and we know the Federal Reserve is now beginning to take a much closer look at food prices and near-term increasing of pass-through from these tariffs. And I think that's something that we all want to focus on, given where what the market wants, which is rate cuts, and what the Fed's likely to do, which is not give them those rate cuts. At this point, we'll be lucky if we get one this year, perhaps in December, should we really see inflation become transitory, and it's just too early to make that call.
You know, it's interesting, especially as we are, to Maddie's point, getting some of those officials that are talking about Trump set it to hold new China tariffs at 30%, according to one official here. As we're thinking through what Torsten Slok over at Apollo, and this just hit my inbox this morning, his outlook for China, consensus predicts a decline in China's growth from its current rate of around 5% to 4% next year. What's the knock-on effect if we do see that hit on their current growth rate in China and some of the U.S. dependency as well that relies on those purchases, those larger contracts as well, Joe?
Well, China's got economic problems beyond the trade war. They've been adjusting due to a significant issue inside their housing and financial sector, and I would expect Chinese growth to slow. Moreover, China is overproducing and attempting to flood the entire zone, that's the entire global economy, with excess production. So they are going to be exporting some deflation. Now, if that were the case in the United States, sure, we'd be talking about something different, but I don't think that's going to be the case. Right now, the effective tariff rate on Chinese goods is above 40%. And by the way, before I finish answering this question, I want to say, you know what the best news is here this morning? I see my friend Claudia on camera, smiling, happy, and healthy. I hope you're doing well, Claudia. It's good to see you.
Great. Yeah, thank you.
That is amazing news. And Claudia, we are so happy every time you join us. So thank you for making the time this morning. But I do want to get your insights before we let you go, because one of the things I'm also interested in here is that inflation is cooling. The labor market, it's decelerating, but we're not seeing anything crazy yet. Are we back to the soft landing question? Is that what this looks like to you?
It's just not the conversation yet. I mean, it's really good to see inflation, be stable this month and not pick up, right? So, but we know there is a disruption. We know these costs are going to get passed through. We're just not at that place to having the conversation of the soft landing. And in some ways, the good news today, it probably delays that conversation. It delays the Fed's ability to say, oh, okay, this is temporary. We can look through this. Now we can get back to cutting rates. It's just going to take some time for this to work its way through.
So should we take 50 basis points in cuts, which is what the market's pricing in through the end of the year? Should we take that off the table, Claudia?
I don't think we necessarily take it off the table. It's timing is tough, right? We're still in a world, and I think today's data reinforces this. We are in a world where the next cut or the next move is likely a cut, right? So then it's a question just with the calendar and the timing and how long does it take for this to work its way through. In some ways, if we have a gradual adjustment to multiple large policy changes this year, if we do it gradually through the economy, that's probably the least pain path. It may mean we delay the rate cuts some, but that may be the price worth paying here.
Claudia, Joe, great to see you both here this morning. Thanks so much for taking the time.
Great.
Thank you.
Let's send it on over to our own Jared Blickery for a look at the movers on the back of this May CPI report. Jared?
Thank you, Brad. We are seeing a risk-on reaction here, and let me just pull up the Wi-Fi Interactive. These are stock futures, so I'm going to show you the Dow futures first, up 1/3%. So it's not a big move, but you can see all night since midnight had been mired in slightly, just slightly, emphasize that, negative territory, but out of that right now. And of course, what matters is what happens into the close, but unlike the non-farm payroll days like we had last Friday, we don't tend to see as many reversals as we do with that report. So CPI more of a straight through in terms of trading action. Here are the S&P 500 futures up a little bit more than the Dow, about 0.5%. And let me show you the Russell 2000 because that has been on a tear lately. The rest of the indices, the majors, have kind of quieted down as volatility has shrunk. But Russell 2000 and its counterpart, the S&P 600, have been flying high. You can see it's up 1.42% this morning. Let me just put the 10-day view so you can see the multi-day price action up 5.5%. Here's the year to date. I'll probably go into more detail on this after the open, but it is broken out of this price memory area, and so now it has some momentum. Let's go back to the futures. I want to show you what's happening in the bond market. We have yields ticking lower. These are the futures. These are bond futures, so these are going higher. They move in the opposite direction, but we saw the 10-year dipped below 4.5% yesterday. It is farther below that mark today. The 30-year is comfortably below the 5% mark. And I should add, too, that we have big auctions on deck. We got the 10-year this afternoon. We got the 30-year tomorrow afternoon, I believe. So that's something traders are going to be watching as well. And let's just take a look at some of the futures markets that I've been talking about here. Here's gold futures. That is up 1%. Now, you can see they were already up on the announcement time, but now solidly higher. And also taking a look at silver, that has been breaking to new highs, but just kind of ho-hum today, barely to the upside. Crude oil futures don't necessarily react off of this report, but I want to point out that $65 was a big price level. Over the last few days, it has climbed beyond that. And then a market which is reacting a little bit this morning is Bitcoin. Bitcoin got a little bit of a pop, pulling back, but you can see it is net down over the last 24 hours. So put it all together, we have this risk-on movement, and I'm going to show you the sector action. So far, we are seeing consumer discretionary, that's XLY, up at 92 basis points, and you can see there it was up 1.20% yesterday. So one of the leaders yesterday, one of the leaders this morning. Energy is in the second spot with that WTI crude pop, and then communication services also in the green. Also taking a look at utilities and tech. And the only thing trading to the downside is materials. And then I'll give you a brief picture of the NASDAQ. One of the stocks that I've been tracking recently, everybody's been tracking, Tesla, but that is up an additional 3% this morning after soaring about 5.5% yesterday. So clawing back some of those losses that we saw late last week. Nvidia up 0.75%. All in all, seeing a lot of nice price reactions so far, and we haven't even started the day yet, Maddie.
We certainly haven't, Jared, but expecting those gains to continue at least off the back of that CPI print. Thank you so much, Jared. Coming up, we're going to have more on the CPI report from May and a look at what categories saw the biggest price changes. That's next on Yahoo Finance.
We want to bring you a breaking news update on the trade front. The U.S. and China reaching a trade agreement after 2 days of talks in London. President Trump taking social media this morning announcing the deal, which included agreements on rare earth supplies and access for Chinese students at American universities. The agreement is still subject to approval by Xi and Trump. Taking a look at some of what we know on this deal, especially with regard to the effective tariff rate, it seems like, according to officials, the effective tariff rate on China will be 55%, and on the U.S., 10% is what we're hearing early innings right now.
Yeah, that's what the president is saying on Truth Social. I'm interested to get clarity on how he got to that 55%, because we know that there is the 30% tariff the U.S. is putting on China specifically, on top of the 10% baseline and the 20% fentanyl tariff, so 20-10-30. Equals 50, but then I'm not sure where that additional 5% comes from to get the total 55%. Having said that, as you mentioned, Brad, this is still subject to final approval from President Trump and Xi Jinping as well. And also the president talking about how any rare earths will be supplied up front by China. He has not posted specifically about what the U.S. capitulated in order to get access to those rare earths up front. We know from a slew of reports that the United United States was getting pressured to bend a little bit when it comes to export controls, specifically with regards to technology and access to chips. So it's likely that we will be getting more information about what those potential capitulations look like.
We also know that Chinese students had always had the ability to come to U.S. universities. Yeah. There's an entire visa process for education, and then additionally, it's really more of the rollback in some of the interest that we've seen amid the trade spat that has been a larger kind of point of contention that the two parties have had to talk about as well along the way here.
Absolutely. Well, speaking of spats, let's move to Tesla. Tesla shares rising this morning after CEO Elon Musk posted on X overnight saying he regrets some of the posts he made about President Trump when they publicly clashed last week. Musk going on to say the post, quote, went too far. Now, this comes after Trump and Musk traded barbs on social media. Their disagreement over the Republican tax bill turning personal, with Musk claiming Trump would have lost the election without him and saying Trump's tariffs could cause a recession. President Trump responding by threatening to cancel billions and billions of government contracts for Musk's SpaceX. The public feud causing Tesla to shed $153 billion from its market cap, marking its biggest ever one-day drop.
May CPI data showing inflation rising at a slower pace, up 0.1% month over month and 2.4% year over year. Joining us now, we've got Colin Martin, who's the Schwab Center for Financial Research fixed income strategist. Good to have you here with us in studio, Colin.
Yeah, thank you so much for having me.
What does this mean for the bond market from what you've been able to read through and assess in this report?
In a vacuum, this means that maybe we get the rate cuts that we've all been waiting for.
At what point?
Still later this year.
Okay.
Now, we never put too much weight on one specific report, but this is a string of months of pretty good reports, specifically with the CPI. The Fed favors more the PCE, but we can't deny that this was a pretty good report on a headline and a core basis at 0.1% increase, coming in below expectations. When we look at the inflation data, we like to break it out between the services category and the goods category, because they can show very different things. If we look at goods, that's where the concern about tariffs come into play, but they came in better than expected. I think there's probably a lot of moving parts there. The idea that maybe companies imported early and they still haven't decided how much they want to pass through because they still don't know. I mean, you just talked about the idea of Trump and Xi and will they, won't they, what is the rate going to be? We don't know what it's going to be. So I think companies might be a little bit hesitant to push those through. But if we look at the services side of the equation, we saw that come down a little bit also. That's good from an inflation front, not necessarily good from an economic outlook front, because if we're seeing airfares down, international tourism down, things that we as consumers are spending on, if it's because we're spending on those less, that's not necessarily a good thing. As it relates to the Fed, yes, maybe it pulls forward the timeline, but we haven't really changed our view just because of this one release. We still think 1 or 2 cuts this year. September is probably the earliest at this stage. We'll see how the next few months play out.
It's interesting because we did see, to your point, services cooling, but also goods cooling, especially in categories like apparel, cars, new vehicles, areas where you would expect, tariff impact to show up. So to what degree does the bond market indicate to us whether or not to believe the cooling narrative in this print versus a narrative that's potentially just not baked in the tariff policy impact?
I'd say right now the market believes it because we did see a relatively sharp decline in yields across the board, whether it's 2-year, which is very dependent on monetary policy in the here and now, but also the 10-year, which looks ahead at what should we expect over the next 10 years. But we take all of these with a grain of salt. I mean, every release is scrutinized so heavily, and if we were to get something that says, hey, maybe this trend is actually reversing a little bit, we'd probably see that play out in the bond markets right now. So our main outlook is volatility. We think short-term yields will probably continue to drift a little bit lower with some ups and downs. We think long-term yields will probably stay sticky. There's a lot of forces that are keeping them kind of elevated, even if we get those expected rate cuts.
This was also a big week in terms of sensing where the demand is, especially with regard to the bond auction taking place. What most notably are you watching for there?
I think today's 10-year auction is going to be really important. We have a 30-year tomorrow. Right. I focus more on the 10-year. The 30-year, who's investing in 30-year treasuries? I mean, I'm not. Most individual investors
are. If we're optimistic about the long-term prospects for the economy, then that's where, and the investments that have certainly been touted, whether internationally or from company perspective, that's where it would seemingly have more interest on the 30-year side.
That's right. It is sort of a vote of confidence, right? Yeah. I focus on it, of course, but we talk to a lot of individual investors, and the 30-year makes all these headlines. Obviously, you get large price swings. If that scares you, don't own a 30-year treasury. That's kind of what we tell investors. But yes, it is going to be important because for the past 2 months now, there's all these headlines about foreign investors potentially selling our treasuries. We don't know yet because we get such a delay. But it will be important to look at, the breakdown at the auction. One, is it a success generally speaking? But what does that indirect bidder look like? Are foreign investors buying more or less in terms of that vote of confidence? We're not worried that the vote of confidence is going to go away anytime soon. We still think the US dollar should remain the reserve currency. It doesn't mean it can't decline a little bit from here. Yeah. I think US Treasuries, despite the recent downgrade, our perceived safety of a US Treasury hasn't changed. But at the margin, if we do see some tweaks here and there that could result in more volatility, if it's a weak auction, it could result in slightly higher long-term yields, which could spook investors a little bit. So it will be important to see who's buying and how much are they buying.
Colin, thank you so much. Really appreciate you making the time and giving us your insights.
Thanks for having me.
Appreciate it.
Well, core CPI inflation rose at a lower rate than anticipated in May. Joining us for a category breakdown, our very own Alexandra Canal. Allie, what are you seeing?
Hey, Maddie. Well, what stood out to me was that we saw the monthly all items increase along with the core monthly CPI coming in below economist expectations here. And a big reason for that was that a lot of economists thought that we were going to see some of that early tariff impact. So, for example, we saw declines in car prices, apparel prices. These were categories that were expected to rise thanks to Trump's tariffs, but we did not necessarily see that this month, and that helped drive the cooler than expected core CPI reading. You saw declines in energy, for example, that was helped by gas prices, which fell about 12% on a yearly basis. However, there are some categories that remain sticky. Food, for example, rising 2.9% on a yearly basis. Shelter still up 3.9%. We saw rent and owner's equivalent rent, which is the hypothetical rent you would pay for that same property, also rising to the upside. Lodging away from home, though, did see some easing, falling about 0.1% here. Now, egg prices, that's something we often talk about here. That was down 2.7%. Actually, I believe it was up 2.7% on a yearly basis, but my bad, down 2.7%. I have a lot of numbers here, but they still remain near historic levels. So even though we're seeing some falling categories, some falling items, that still doesn't mean we're out of the woods yet when it comes to the consumer story and what they're ultimately paying for. But hopefully with this truce that we just got between the US and China, some of that impact is a little more muted.
Yeah, I was going to say, my eggs better be down 2.7%.
Otherwise,
my receipts
usually
are off.
it's on the upside. So I was like, I said that at first, and I said, are we actually down? But yes, we're down, which is encouraging, especially considering all of the risks that we continuously hear about these price increases.
Allie, thank you so much. We'll continue to track this. Going into our next hour here, we've got much more ahead on Yahoo Finance. Morning Brief begins in just a few minutes. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things you need to know today.
First up, U.S. stock futures pushing higher this morning following the May CPI report, which showed consumer prices coming in softer than Wall Street had expected. Latest inflation print easing investor concerns over price pressures, which could have kept the Federal Reserve rate cuts off the table.
Plus, the U.S. and China reaching a trade agreement after 2 days of talks in London. President Trump taking to social media this morning to announce the deal, which included agreements on rare earth supplies and access for Chinese students at American universities. The agreement is still subject to approval by President Xi and President Trump.
And Tesla shares moving higher this morning after CEO Elon Musk took to X to post regret about his social media spat with President Trump last week. Their disagreement over the Republican tax bill turning personal. Musk claiming Trump would have lost the election without him and saying Trump's tariffs will cause a recession. President Trump responding by threatening to cancel billions and billions of government contracts for Musk's SpaceX. The public feud caused Tesla to shed $153 billion from its market cap, marking its biggest ever one-day drop.
U.S. stock futures edging higher this morning as the market looks beyond trade and hones in on some data here. Today's CPI report coming in better than expected. Joining us now, we've got Yahoo Finance markets reporter Josh Schaefer here. All right, Josh, just take us into how excited we should be about this.
Yeah, Brad, a lot of news over the last 12 hours, right? Yeah. So you have this somewhat agreement with U.S. and China that seems to be a little bit murky on exactly quite what the details are. Then you had the president posting on Truist Social earlier this morning at about 8:05 saying that that deal that was being reported on is accurate, but it hasn't been signed yet, right? You're looking at his exact post right there. What was interesting, though, so that came out at 8:04. President Trump posted that. Futures didn't really move. Futures were down, right? And so then we're waiting for the CPI print. We're waiting for the CPI print. Okay, inflation in May, better than expected. Bang, futures move up. This is what we've been talking about with the stock market for about 2 weeks now, is it seems like the market is not really paying attention to a lot of these trade headlines. You're looking at it on the chart there. Look at where that large move up came, a little bit after 8:30 in futures, right? So it definitely seems like this is kind of the epitome of what we've sort of been highlighting for, again, the better part of 2 weeks now. We've been writing about this in the Morning Brief newsletter. We've moved past every incremental headline on trade deals is going to drive this market. Yeah. People are waiting for the data, waiting to see what's going on actually in the economy. And at least for May, the tariffs didn't increase prices as much as the street thought, right? And so that's a positive. Stocks move higher. You see the Russell 2000 catching a bit, futures tied to the Russell 2000 catching a bid, maybe some rate cut hopes building into this market. Yeah. But I think it's definitely starting to feel like the past couple of weeks, we're starting to move to a new regime as far as market narrative here goes.
Moving past the potential impact of tariffs, it's interesting. We asked Claudia Sahm about this earlier, a fantastic economist who we speak with often, and she said that you can't fully trust the cooling in this inflation print because obviously the tariff impact has not been fully baked in yet. How at risk are investors then if they get a little too excited off the back of these data points that come in that don't necessarily show the full tariff picture yet?
Yeah, I think so. A lot of strategists right now, Maddie, are sort of talking about that the next few months are going to be choppy, right? So we talked about Scott Kroner from Citi moving up his S&P 500 target to 6,300 from 58, right? 6,300 isn't that much higher than we are right now. And so he sort of dug into, well, I don't think it's going to be a straight line, right? And I think at some point, many investors do expect that CPI line that you're looking at right now to come back up, right? There's going to be some level of these tariffs increasing prices. The large question when we always talk about markets is it going to be more or less than people think, right? Right now, yes, people think prices are going to go up. Maybe core CPI moves a little bit above a 3 handle from that 2.8, but how high does it go? And does it go lower than some expect? I was at a roundtable earlier this week, and one Wall Street economist was projecting maybe core CPI hits 3.5% by sometime next year, by the end of this year into next year, right? Sort of at peak tariffs. That's pretty high.
That's really high.
So if we don't get that, then is that good news, right? So I think that's sort of where the data is starting to come in now, and we're going to have that discussion over the next couple months. Is the increase, as economists still argue, is probably coming. But if it's not as bad as we initially thought, does the Fed have room to maybe ease later this year? And does that sort of clear the picture on everything that's going on right now? And again, I mean, uncertainty has been the word of the last 2 months. And I think, of course, that path over the next 3 months still remains uncertain.
But it's kind of the flippening we were looking for, right? And I don't mean to trigger or just gaslight our crypto friends out there, but this is the flippening, at least in trading mindset, that we were waiting for. Right. Fading some of the tariff-related headlines and getting back to the data that the Fed is most focused on here. UBS saying this morning the recent Trump administration actions point to negotiation, not escalation. Checkbox that. And then additionally, you look at how they're looking through the base case of effective tariffs. They think it ends the year near 15% level on Chinese goods, higher at 30 to 40%. So it's clear firms are really just placing more of the emphasis around where the effective tariff rate ends the year at. and they're trading based on that.
Right.
And then giving more priority to, okay, now the unknown is timing the Fed here as well.
Right, yeah, exactly, Brad. And of course, that looming question still being the labor market, right?
Right.
Does the labor market hold up within that conversation, right? If tariffs do end, we've accepted tariffs are coming, tariffs are going to be a thing. I think most bullish people that still think stocks can go higher would have the unemployment rate staying relatively steady at this point too, right? You're not expecting a large increase in the unemployment rate and sort of the labor market to cool significantly, right? So that also becomes a key part of that conversation as we think about the Fed and whether and how much they would cut this year.
Josh, always great insights. Thank you so much. Appreciate it. U.S. and Chinese officials reached an agreement during a London meeting this week. President Trump cheering the deal on Truth Social this morning, outlining some of the details and hailing the relationship between the two countries as excellent. Here are the details. Our very own Fed correspondent, Jennifer Schomburger. Hey, Jennifer.
Good morning, Maddie. Treasury Secretary Scott Bessent set to testify this morning here on Capitol Hill, just hours after wrapping up 2 days of trade negotiations with China. Bessent, along with Commerce Secretary Howard Lutnick and U.S. Trade Representative Jamieson Greer, were able to restore the trade pact that was struck in Geneva just last month. But there are still question marks about what is exactly contained within this framework. President Trump posted on Truth Social about an hour ago that it looks like tariffs are actually going to rise to 55% on China from 30%, while China will have a 10% tariff on the U.S. He said, "We will provide to China what was agreed to, including Chinese students using our colleges and universities, which has always been good with me." He said the relationship is, quote, excellent. Now, apparently, reportedly, the Chinese drove a bit of a hard bargain, asking whether the U.S. would lift export controls on certain U.S. technologies to China in return for lifting export controls on those rare earth minerals, that roadblock that had emerged in talks that inspired the second set of conversations. President Trump implying that will likely go forward. Commerce Secretary Lutnick saying Tuesday evening that once the Chinese begin exporting those critical rare earth minerals, that the U.S. will lift export controls on some U.S. technologies. President Trump saying, though, that he still needs to approve this deal, and Chinese President Xi Jinping also needs to sign off on this deal. So still a lot of question marks remaining here. Now, Secretary Bessent set to testify before the House Ways and Means Committee at 10 a.m. this morning, where hopefully we will get some more details on this deal. And guys, separately, last night we learned that a U.S. appeals court ended up extending a stay that had been put in place, reversing the U.S. International Trade Court's ruling that had rendered the president's tariffs under IEEPA, that International Economic Emergency Powers Act. So those reciprocal tariffs still remain in place, although they have been paused for 90 days. A hearing has been set for July 31st. Back to you.
Jennifer, thank you. The president took to Truth Social Wednesday morning, declaring that a trade deal with China was done and outlining details of the agreement. With more on what this means for the broader trade picture, let's bring in Greg Valliere, who is the AGF Investments Chief U.S. Policy Strategist here. Greg, just take us into your reaction. You see, of course, again, this coming across social media, and now a few officials also speaking what seems to be as sources on the record, at least here. There we've got the Truth Social post up on our screens for viewers watching at home. What was your initial reaction? Is this actually hitting the mark?
It's an improvement. It's good news, Brad. I think my main reaction was by noon today, I virtually guarantee there will be a very pointed email text from Donald Trump talking about Jerome Powell. I think that getting inflation down was a pleasant surprise for Wall Street, but it will incite Trump to resume his demands that we get a rate cut.
So just to reiterate, does this hit or miss the mark of what we were expecting coming out of these multi-day talks in London between the U.S. and China?
Don't know. The atmospherics were good. I think that, as we all know, a big country trading with the U.S. could take months and months and months to get a deal done. They may have to extend deadlines, but this is the bottom line here is this is a positive development.
Well, it's fascinating, Greg, because, and I'm hoping you can help me with the math for a second, because the president posted about a 55% tariff rate on China, but I'm not getting that when I do the math. It's a 10% baseline, a 20% fentanyl tariff, and then 30% on China. That's more than 55%. So how did he get to that 55% number?
I don't know.
Yeah.
I only made it through algebra in high school. I never got to geometry, so I don't know. Not sure how they came up with that number.
Yeah, and it makes me wonder, too, to your point, the degree to which investors can believe these headlines as they come through. I know that you don't talk to people about how they should be investing, but people ask you questions about policy to get clarity on their investments. What would you tell them to do off the back of tariff headlines like this?
Yeah, unless they're day traders, I'd advocate caution. I think that we need to see, as you guys point out, we need to see all of the details here. But again, I'll go back to the other point, the other big story this morning. I do think this inflation number is quite positive. I think the bond market and the stock market it will at least think this is a temporary move. Maybe inflation goes back up in the fall because of tariffs, but the number this morning was a good one.
Do you think that it encourages the Fed to take any more immediate action?
No, I think that Trump would like to see it, but I think that Powell and people at the Fed still don't know if this is a temporary trend or a more lasting trend. So I think they're prepared to wait until mid to late summer before they pull the trigger.
It's interesting, too, because we have some reporting from Bloomberg about who the next Fed chair could be, and they are indicating, according to their sources, that Treasury Secretary Scott Bessent might be considered as the next Fed chair. What do you think about that?
Interesting. He's highly regarded. They've got a long time to go. They've got well into 2026 before they have to make a choice. So there'll be a long time to vet this, and they could do worse.
And so as we're thinking through what would need to be and what could be playing out at that point, both on the inflation front, but then additionally on the other side of the Fed's mandate, on the employment front as well, what should we be expecting the trend to lock in at on unemployment, given what a lot of businesses are saying and signaling in that they're trying to figure out how much they should be hiring, how much they feel comfortable hiring, knowing that they're still looking for answers on the macroeconomic and tariff policy front?
That's a really good question. I think we have to wait probably until fall to see how the labor market is. You just get the sense that the economy is softening. It's not decisively softening, but it looks a little weaker. And if urban unrest spreads from LA to Chicago to Atlanta, that doesn't help. So I would say that the likelihood is growing that the next move will be by the Fed to cut rates, but I still think it's a few months away.
Greg, I want to ask you about some of the policy impact for the unemployment rate that could be driven by some of the immigration policy of this administration. We're obviously seeing this playing out in LA right now. To what degree are you concerned about further cracks in the labor market off the back of the administration's hostility towards immigrants?
Frankly, I'm surprised that people don't discuss this more. In many areas of the country, especially California, there still is an acute shortage of labor. I have a lot of friends in California. They can't find anyone to fix their roof or do all sorts of things because the labor market is tight. And considering all the unrest we've seen this week, the labor market might even get tighter. This will dissuade people from coming illegally to the U.S. and might prompt some of them to go back to where they came from. So a really tight labor market, I think, is another big factor that I think will become more dominant over the next few months.
What are the sectors that we would have to see that in, especially thinking through the non-farm payrolls print and for the amount of positions that wouldn't even show up in that print because it is non-farm payrolls, and we know how many of those roles as well rely upon either undocumented immigrants or people who are just trying to make sure that they are going through the process but still waiting on those opportunities to solidify citizenship?
Again, I think we need more time. I know that this has been the mantra from the Fed chairman, and I think he'll still make this his mantra. I think it's next week when he testifies again. So we still have a ways to go to definitively say the labor market is starting to turn around. But to me, the labor market looks like it's softening.
Greg, I want to switch gears a little bit and talk to you about the president's latest feud with Elon Musk. We did see overnight Elon Musk expressing regrets about his commentary towards the president. All of this sort of started because of the tax bill. To what degree do you agree with Elon Musk about his concerns about the tax bill and the deficit?
Well, if you talk to deficit hawks here in Washington, they are aghast at the price tag, exacerbating the depth of the deficit. And I think Musk is one of them. His problem was that he spoke the truth in public. That's a cardinal sin in Washington. I think if he had made his criticisms private, we wouldn't have had the big fight between the two of them. So my sense is that Trump will never really make up with Musk. Maybe they'll speak to each other, but I think that's a relationship that's pretty much shattered. And it does give the Democrats a little ammunition and the Republican hawks a little ammunition over the next few weeks to make this bill more deficit reducing.
Greg, just lastly, while we have you, and I guess we'll end this kind of circularly where we began, what does the opening of U.S. and China look like? What does the follow-through also need to look like on purchases, knowing that this runs counter to what some members of the administration and advisors campaigned on?
Yeah, good point also. And I think that this drags on and on and on. There's a myth that once we say we've got a framework, we've got a deal. It's great to have a framework, no complaints there, but I think it's going to be months and months, maybe Christmas, New Year's, sometime this winter before we get a text on a trade deal. That's a long way off.
Greg, always appreciate your insights. Thank you so much for adding some clarity to the continued policy confusion. Thank you. Coming up here on the Morning Brief, we'll count you down to the opening bell on Wall Street. Plus, NVIDIA shares within reach of record highs. We'll break down the why behind it, and Tesla getting a boost as Elon Musk expresses regret over his spat with the president. Details to come.
Now time for some of today's trending tickers. We are watching NVIDIA, quantum stocks, and Tesla. First up, NVIDIA nearing a record high as CEO Jensen Huang delivers the keynote address at the company's developer conference in France, Vivatech. Huang speaking about the future of AI and the company's partnerships with European telecommunications companies to build AI infrastructure. There you're taking a look at shares up by about 0.7%. Of course, a lot rocking in France as of right now over the next few weeks here. You've got Vivatech, you've also got, of course, Cannes. So between all of the high profiles in business who are just kind of planted out there for a few weeks, it sounds like, you've got a lot of announcements that could make their way. Oh, you've also got the Paris Air Show taking place too.
There you go. Yeah, great insight there, Brad. It's interesting because I'm just taking a look. NVIDIA is not at its all-time highs of the year just yet, but we are getting close to it. And in order to get that, we've got to see the stock hit $153 a share. You can see right now it's at $144. It's going to be interesting to see whether or not some of the broader trends that we've been seeing in the market, things like softening inflation, cooling inflation data, for example, can be enough to lead to some of that broader index buying that leads to a gain in some of those heavily weighted stocks like NVIDIA. Also, if we see any potential headlines about DeepSeek continuing to not be a problem, we keep hearing from sources on the show that that's kind of in the rearview mirror. Is that narrative going to stay in place? All of those things could potentially power the stock to new all-time highs as the CEO on a bit of a tour in Europe to look for potentially more global relationships amid some of the trade uncertainty here in the United States. Well, next up, let's talk quantum stocks rising as NVIDIA CEO Jensen Huang grows more bullish on the sector. Huang saying quantum computing is reaching an inflection point, and he expects the technology to start solving real-world problems in the coming years. You can see all of those quantum stocks moving to the upside along with the broader market, but certainly heavy moves, especially for the likes of Rigetti there off the back of these comments. And it's interesting because we've heard this from Jensen Huang before. He has talked about how he is bullish on supercomputers. He's even invited some of the CEOs of the companies that I just mentioned to NVIDIA events previously, which is a signal of his acceptance of the sector.
I think you're seeing so many of these stocks also moving higher in concert together because you have more potential buyers of some of these smaller businesses if you were to see an acquisition in order to scale on a more rapid clip of any of these smaller companies. Think back to what IBM was just talking about earlier this week as we were reading through what their quantum roadmap looks like, the processors, the infrastructure that are part of that path to IBM Quantum Starling, the first large-scale fault-tolerant quantum computer here. And so it's not just how these companies have also been ahead of the curve, but also where some of the larger entities who have a lot of cash on hand that they could potentially put to use, where that dry powder could come into the coffers, and ultimately how that could prop up some of these other businesses in IonQ, D-Wave, and Rigetti that have certainly garnered a lot of investor appetite and eyeballs given the astronomical growth that we've seen in some of those deep quantum value plays over the past year. Absolutely. Finally here, let's talk a little Tesla. Tesla rising after CEO Elon Musk says that he regrets some of the posts that he made about President Trump when they publicly clashed last week. This comes as the automaker prepares to launch its long-awaited robotaxi service on June 22nd in Austin, Texas here. Shares right now are higher pre-market by about 2.7%. Hey, I would be sorry too if I ultimately knew that it was going to go against some of my requirements to shareholders as well of Tesla, knowing that, and as we had seen kind of during that spat, about $150 billion plus lost in shareholder value. That would make any holder of TSLA shares a little concernicus for the longer term prospects and the relationship between the company's head and poster child and face of Tesla and, of course, the person sitting at the Resolute desk in President Donald Trump.
Yeah, it's a stock that doesn't trade on fundamentals, so it's going to move off the back of individual headlines like this. Obviously, we have the robotaxi event this week as well, with Elon Musk talking about how robotaxis would be available in Austin, Texas as soon as June 22nd, so perhaps that being a touch of a catalyst for the stock as well. But for investors in Tesla, certainly on a wild ride year to date here. For our broader audience of investors, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page.
We've got all your markets action straight ahead. Stay tuned. You're watching the Morning Brief.
That is the opening bell on Wall Street. Taking a look there at the New York Stock Exchange and the NASDAQ on Wall Street from this morning. But let's take a look here at your major averages continuing their moves to the upside, hitting session highs off the back of that cooler than expected inflation print. Just want to see where we are opening for the morning. So we're at 60.50 on the S&P 500. That means we are under 100 points away from hitting a new record high. The number we're looking for is 61.44 for your S&P 500. That is the last record high that we had back in mid-February before all of the tariff-induced volatility. Is the market ready to move past that tariff volatility and instead focus on the economic data? That is the key question that we've been digging into with our sources on the show this morning. Having said that, I'll give you a look at the broader averages this morning. You've got your tech-heavy NASDAQ up 0.3%. Your Dow Jones Industrial Average is just above the flat line. It's also interesting in big economic days to take a look at the bond market. We do have yields coming in just a bit here off the back of that inflation data cooling, and expectation here that the Federal Reserve may be able to cut rates sooner rather than later. Folks telling us this morning that we could see September as that key rate cutting date. Lastly, of course, as I always do, I want to take a look at the US dollar, down 0.3%. Can we get a full snapback in the S&P without a recovery in the dollar, which is still down over 9% year to date, Brad?
It's time now for today's strategy session. Analysts across Wall Street are turning bullish on U.S. stocks. Multiple strategists boosting their year-end 2025 targets on the S&P 500 after stocks recovered from their tariff-induced sell-off. Joining us now, we've got one of the strategists boosting his target, Keith Lerner, Truist Co-Chief Investment Officer and Chief Market Strategist, and good friend of the show. Keith, good to see you here. Just take us into the thesis behind why you're now raising your target as well.
Yeah, well, great to be with you all. Maybe I'll take a step back for some context. Back in February, we were around all-time highs. We downgraded equities. And then as towards the lows, we would tell our clients to rebalance, that you should start thinking about upside risk. On the initial rebound, when we had the rebound, we actually modestly took some off the table. In hindsight, somewhat prematurely. But at that time, our work was suggesting that recession risk was still relatively high. after that, China kind of walked back. So now, as we kind of reset and say, okay, where are we at now? In the weight of the evidence in our work suggests at least more of a neutral posture overall. And as we look at things, one, the rebound off of this low is actually a positive sign when you look off 6 months later. Instead of recession, being say 50%, I think our base case is more of a muddle through. And when something that's changed since February when we first downgraded stocks was earnings. Forward earning estimates for the S&P back in February were starting to move down. That's part of the reason why we downgraded stocks. Now they have inflected higher. A lot of that is being driven by tech and communications, and that's the final point. We had all this tariff uncertainty, right? The big T was tariffs. I think what the market has found over the last few months is the other T, technology and AI, which has been the dominant theme of this bull market, is back in the forefront.
Yeah, Keith, really excited to get your thoughts on the tech sector specifically, which, as you mentioned, you did upgrade as part of this. To what degree do we continue to learn the lesson from investors that you can rest on your laurels of the Mag 7 stocks, those big tech stocks, regardless of the broader market activity? And how bullish does that make you?
Sure. Well, the first thing I will say, we've been overweight communication services, which is kind of also an AI play all year long. We added to tech. And I think what's also important with tech, I know a lot of times we're looking at how much we've moved from the lows for the market and tech. But if you look at the S&P technology sector since last July, we're flat. And you spoke about NVIDIA earlier. That's also only up modestly since last July as well. So if you look at the big picture for the overall market, the S&P, we're flat for 7 months. For the technology sector, flat for almost a year. So I think as we test these kind of technical levels, I think eventually we will break above that. There's probably some pain trade. That said, I just want to be clear too. I mean, we are starting with higher valuations for the overall market. So I think there could be a squeeze higher, but I don't know that we're off to the races. I certainly expect that there'll be some bumps along the way, especially in the summer where we see some illiquidity along the way. But I think in general, the underlying trend is still positive, and we want to stick with that underlying trend.
Okay, you started to answer my question, which was around valuation. So I'll tap more into that illiquidity. Does that mean low volume during the summer means more volatility in this interim period of time?
Well, I think what can happen is, well, I'm hoping for the summer doldrums, right? After what we've seen in the first half, like some boring trade would be actually probably good. But I think what can happen is if you get some unexpected headlines, a lot of people are on vacation, there's less liquidity, that I think you can see moves exacerbated as well. And there's an old saying, sell in May and go away, but that's actually incorrect. What happens really, the market tends to do well until July, and then that's when you start to see more seasonal weakness as you get into August and September. So I think that's something to be kind of on the lookout for. And again, for the economy, we're expecting more of a muddle through. So this isn't to our view like, hey, this is time to be on all offense. But again, I think for investors and even people watching the show today, I think we'd be more aligned with long-term target, equity allocations. Again, not overly, on offense or defense, but the underlying trend, again, I think we have to respect it.
Right, don't fight the tape, it sounds like, is what you're saying, Keith. But I wonder to what extent you feel that investors are somewhat post-tariff and instead focused on the moves of the Federal Reserve, especially given that we are seeing such a strong market reaction to that cooler than expected inflation print this morning. Does today's market action show that the market is moving from being Trump-driven to Fed-driven?
I would almost say neither. I mean, they're both important, but I think the way I think about it is for some period of time, tariffs were the only thing that mattered. And I think we're finding out today a lot of other factors matter. So tariffs still matter, just not the same degree. The Fed still matters, but not the same degree. And I think the thing with the Fed right now, the reason why I say it matters, but it's, even if you look at the Fed funds futures or what the market is pricing in, the first rate cut is September. So think about where we are today. We're still in June. There's a lot of time between now and September where the Fed really comes back into play in a meaningful way. I think this is the step in the right direction, showing CPI coming down. I think there's still some lingering questions. Are we going to see some changes in the inflation data as some of the tariff impact comes in? I think that's an open question as well. So in the interim, I do think, I do think the economic data matters a lot, meaning there was a lot of concern about recession earlier on. Are we going to see some air pockets over the next couple months? Is going to still show some resiliency. So things like the weekly jobless claims are going to be important. The employment picture is going to be important. The inflation trends and the Fed. So again, I think all these things matter, but I don't think it's as just specific. Like this is the main thing the market is now focusing on. And again, going back broader picture, back to the conversation, tech matters and what happens on the technical side as well.
Keith, just briefly while we have you here, it seems that a lot of firms and institutions are trying to measure what the base level of effective tariffs end the year near, and what that also looks like for Chinese goods as well within that broader picture. 15% is what one firm that I cited earlier in the show is tracking towards, and then the level of Chinese goods higher at 30 to 40%, their estimation. How are you at Truist modeling that?
Yeah, I don't listen. I think this isn't precise. There's a lot of moving parts. There's the sector tariffs on top of the universal tariffs. So I think the baseline for a lot of countries will be 10% higher on China, some sector tariffs inside on top of that. And again, these negotiations, as Greg Valliere just talked about earlier, who is going to take time. I mean, this doesn't happen overnight. But I think from the market's perspective, if that is the baseline, and the market can likely adjust, they understand it. If it becomes where we have some tougher negotiations, and you may have some of that causes that volatility in the summer later on, I think that will scare the market. But at this point right now, where they are today, I think the market is comfortable that companies can adjust. But it's still an open question where we end up, say a year from now or 2 years from now, because we're really just beginning this longer term process.
Keith, amazing to chat with you. Thank you so much for making the time this morning.
Great to be with you guys. Thank you.
Let's get to the 3 market movers you need to watch for your trading day. Yahoo Finance's Jared Blickery has more. Hey, Jared.
Well, thank you, Maddie. We've got all the hallmarks of a bull market. We've got the majors just inching higher as volatility kind of ebbs here. We've got rates calming down. And then on the commodities front, we're seeing platinum soar, and also Bitcoin, well, it's consolidating near recent highs. So let's go back to the S&P 500 on the Wi-Fi Interactive, and I will show you. It's just up a handful of points right now for the early trading day. But here's over the last 10 days, and you can see it has traced out a very gradual rise here, with the exception of this brief dip below that line late last Thursday. It has been up to the right, and that is what we want to see here. Now, the S&P 600, this is the small cap index, has been even steeper over the last few days, and this has been really catching my attention. I've been talking about small cap leadership over the last few days. Here is the year-to-date chart, and finally we are getting a little bit more of a breakout from this neckline of this inverse head and shoulders pattern that I have talked about almost ad nauseum, so I won't spend any more time there. But I do want to highlight the VIX Volatility Index, because this has now reached the lowest point in, let's see, I think that's 3 months now. So VIX calming down, that means volatility is dropping as indexes climb higher. And by the way, there's a read-through on systematic flows. There's some there's some automatic funds that are allocating capital based on this dropping volatility in the tens to hundreds of billions of dollars. So that is a tailwind now. We got to get to the 10-year T-note yield, because that is solidly below 4.5%. We have a big auction this afternoon for that 10-year T-note yield, $39 billion at 1 p.m. Then we have the 30-year tomorrow, $22 billion. So there are going to be a lot of eyes on this. And let me just jump to the 30-year. This is a year-to-date chart as well. It hit 4.90%, but it's up a little bit from that. Nevertheless, down below that 5% is where we want to see that stay. And let's move on now to Bitcoin, because after a blistering 5-day rally, I think it covered something like $10,000. It is back to its record highs, very close there, 112,000. It's just short of 110 right now. No surprise to see it stall out a little bit and maybe gain some momentum. I'll check in on Ethereum again, up just a little bit today. It had a big breakout yesterday, but you can see it has now exceeded that consolidation that lasted 4 weeks. So that is a positive development. I think we want to see some more altcoin action if we're going to get a huge breakout in Bitcoin to those records. So we'll see if that develops as it just kind of consolidates near those highs. Behind me is the commodities market. This is our heat map featuring platinum in the upper left. That is up 5.06%. Let me show you the 10-day. It has just been surging 4% in, I think, 3 of the last 5 days. Anyway, it is up 20%. Here is the year-to-date, clearly breaking out to new highs here. So platinum futures has been the market to watch here. I've been tracking gold, copper, silver, but I want to close here with crude oil, because that is steadily holding above $65 a barrel. That's another inverse head and shoulders pattern that I was watching, broken to the upside here. So we could see momentum in the crude oil futures. We're seeing a little bit of that today, up 2%. And back to you, Brad.
Jared, thanks so much. Teeing up today's trading activity. Appreciate it. We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief.
Jennifer General Motors planning to invest $4 billion in its U.S. plants over the next 2 years to mitigate the effect of tariffs. Here with more details, Yahoo Finance senior autos reporter Praz Subramanian. Praz, great to speak with you this morning. Talk to me about this $4 billion commitment.
Yeah, Maddie, so $4 billion to augment their current plants to boost U.S. production. This new investment will give GM the ability to assemble more than 2 million vehicles a year, create 3,000 to 4,000 jobs. It's union jobs. And the vehicles that'll see more U.S. production are the gas-powered Chevy Blazer and Chevy Equinox, which are both currently made in Mexico. Now they're coming to 2 separate plants in the U.S. And some gas-powered full-size SUVs and light-duty pickups like the Silverado, which are coming to Michigan. Some of these are currently built in Mexico as well. Now, this is in response to those 25% tariffs, sector tariffs that we saw on autos and also USMCA imports, though there are some parts exemptions. And the moves today are sort of seen as a long-term mitigation effort, GM says, not related to the mitigation that they're doing right now to bring down some of the $4 to $5 billion in tariff costs they may see this year.
Ross, while we have you, we know we are just, about nearly 10 days, a little more than 10 days away from Tesla's robotaxi launch, but very specified to one region, so we won't have it here in New York just yet. What do we know?
Yeah, so, reportedly Tesla was planning a June 12th unofficial start to that robotaxi test. And then we saw Musk early today tweet that actually they're going to do a preliminary start of June 22nd. Now, a little bit later than what people thought, but we also have seen images online of actual Tesla Model Ys with robotaxi emblazoned on the side, testing in the city now with chase vehicles. So they're actually sort of putting the car through its paces. They're not picking anyone up yet, it seems, but that seems to be coming on the 22nd. And the 28th, Musk claims that Tesla will deliver its first vehicle from the factory direct to a customer all autonomously. So these are some big things that are coming down the line. Obviously, they're getting pushed back, and Musk said that they're being super paranoid about safety, and that's why it could even push back that date even more. So good stuff with the bad stuff here mixed in for robotaxi testing.
Ross, thanks so much. Appreciate it. And stay tuned for Process Conversation today with GM CFO Paul Jacobson, 3:45 p.m. Eastern Time. You do not want to miss that conversation. Coming up, we're awaiting comments from Treasury Secretary Scott Bessent. That's imminent. Treasury Secretary Scott Bessent is set to testify in front of the House Ways and Means Committee this morning starting 10 a.m. This comes amid speculation that Bessent is President Trump's pick to succeed Fed Chair Jerome Powell. Other officials potentially under consideration for the position: former Fed official Kevin Warsh, National Economic Council Director Kevin Hassett, and Fed Governor Christopher Waller. John Hilsenrath, StoneX Senior Advisor, joins us now. John, good to speak with you this morning. Just take us into your perhaps guesstimation of who is best positioned to fill this role, at least through the streets lens.
Well, Kevin Warsh has been the leading candidate in this horse race for some months. But I think what we're seeing with this Bessent speculation is that this nomination isn't going to happen without its fair share of drama. I think as we saw with the president's decision-making process back in 2018, there was back and forth. He likes to poll his advisors. He likes to poll people in the public. He's very focused on the Fed. So I think we're going to get several months of back and forth on this. The other point I would say is that there's some sequencing issues here. There's a Fed governor position, not the chairman, but a governor position opening in January. And that's really the only opening on the board that the president has to fill unless Jay Powell decides to step down, in addition from his chairman spot, from the governor spot that he holds for several more years.
Yeah, it's interesting, John, because obviously all of this is not going to take place for several months. So it makes me wonder why the focus on who that replacement is going to be. No matter what, it's going to be someone who the president thinks is going to be dovish. That's what he wants, is more rate cuts.
Well, I think this is why there's so much focus on it, is there's just a lot of uncertainty about what the president wants and what the president will get. I'll use an example. Kevin Warsh, who's been talked about a lot as a leading candidate for the Fed. He's had a hawkish history. He left the Fed back in the 20-teens because he wasn't happy with the Fed's quantitative easing programs. And he's talked a lot about a strong dollar and stable inflation. So is the president going to pick someone who commits to lower interest rates? Is he going to pick on some other set of criteria? I think there's a lot of uncertainty here, which is why the market is going to focus a lot on this decision over the next few months. And then, frankly, the other issue is the people in the market just love to speculate about the Fed and about horse races. It's the perfect story for people like us in the chattering class to be talking about.
You know, we were having the conversation, Maddie and I, within the break of what this would mean, especially given that Scott Bessent has been one of the more measured voices that has been able to speak and respond when markets are skittish, whether that be equity markets or bond markets. And so that considered, if he were the Fed chair, that would place more of the emphasis on just that dual mandate and not speaking specifically about markets, specifically on the equity market front.
Yeah, and this is why I'm a little suspicious of these Bessent stories. I'm not inside the president's head, so I can't say who he's going to pick. But, Bessent has positioned himself over the last couple of months as really one of the top leading, most consistent voices and the top voice in this administration on economic policy. So, he had some rivalry early on the tariff issues, but now he's leading the charge on that. Why would he want to leave the Treasury job? He's in a really good position as the Treasury Secretary to be a top economic policy maker. So I'm a little dubious about Bessent, but as they say, we shall see.
Well, I want to talk about Treasury Secretary Scott Bessent's day today. He is set to testify on Capitol Hill. Of course, this comes after President Trump posting on Truth Social saying that the deal with China is done. What are you anticipating hearing from Bessent today?
Well, I think we're going to hear a very optimistic story about Bessent. And this leads me to something that I think is really important to talk about right now, which is the inflation numbers that came out today. The consumer price index came in pretty soft. It's up 2.4% from a year ago. It looks like the Fed's main target, the personal consumption expenditure price index, is getting very close to the Fed's 2% target. This matters for two reasons. And this is something that I think we're going to hear from Bessent. One is all these economists have been saying that the president's tariff policies are going to cause consumer prices to rise. It is not showing up in the numbers. It's shown up in the headlines for months, but it is not in these numbers. And I think that we'll see Scott Bessent take a victory lap on that point. But the other reason this is really important, these CPI numbers coming back to the Fed, is this opens the door for a Fed rate cut. And I would say a good news Fed rate cut maybe around September. The Fed has been hesitant to cut rates again because it's been uncertain about the inflation outlook. If we're not going to see a lot of pass through from the tariff policies into consumer prices, the Fed might have an opportunity to cut rates, not because the job market is weakening, but because inflation is soft. And that's a really positive story for the markets.
John, good to have you here with us today. Thanks so much. We're going to be talking more with John on the other side of Bessent's comments in the 10 a.m. hour, so stick around for that. And that just about does it for Morning Brief. But before we go, just want to take a moment to bid farewell to my co-host extraordinaire, Madison Mills. Maddie, you've been a pleasure to be at the desk with. And of course, we've had the opportunity to connect through an old colleague and teammate of mine even prior to you coming to Yahoo Finance. Yeah. You far away exceeded expectations and any goals that have been put in front of you. So thank you for sharing the screen with me and allowing me to take some of your time every day as well.
Hey, right back at you. I really, it's so great to end it with you because you were the first person I got to fill in with on Jobs Day, no less. So really excited to wrap it up with you, Brad. Thank you so much for everything. And a huge thanks, of course, to our team, our EP, John, who I admire so much. You guys make it so easy. And a huge thanks to the audience, too, those of you who found me on TikTok and given me story ideas over the last year. Thank you for making my job easier as well. So I really do appreciate it. I'm still going to be covering markets in my next move. So folks can find me on the internet, and I'll miss you guys. I'll be watching from afar. So thank you so much again.
We'll be tracking your success.
Thank you, Brad. Appreciate it so much. You can join me in the next hour for my final hour with more analysis on Catalyst. And Brad will be back with you here for Wealth after that at 11 a.m. Eastern Time. Stick around.